we want to do is we want to go out and forecast revenues. And again, we're still working within the context of Maya. So we have some sense of what growth is going to be like for 2020, 2021. We're going to put that model to work in an attempt to forecast revenues. So from a structure point of view, if you think in terms of the sequence of work that we need to do, we need to start first with identifying what are the key models that we're going to work with. So we're going to work with the inputs which we've identified, then the business drivers, then our assumptions, then our growth outlook. So we've done this. We'll spend some time on this now, and this is our next big step. Once we've done these four things together, we should be in a position to put together what we call an income statement. Income statement is, what dollars come in, dollars go out. What does that look like? That's it. So we again keeping it very, very simple, very, very to the point, because our focus is not so much on the mechanics, but on how we use them as founders. Once we've done the income statement, we will take a look at the balance sheet. The balance sheet is simply a breakdown of stuff that you own and stuff that you owe. So, stuff that you've borrowed and stuff that you own. So if you're running a business, serving customers, fulfilling orders, that allows you to go out and generate revenue and sales. But in order for in the process for you to go out and serve customers, you need multiple items. Some of those items you bought, you've purchased, you outright own. Some of those items you go out and borrow. So that's where the balance sheet comes from. For our purposes though, a key element, a key component out of financial statements is what we call the statement of cash flows or the statement of free cash. And that basically says that when you take these two pieces together, when you take the income statement and the balance sheet together, what is the net impact on the amount of dollars I have in the bank? So, how does that change my cash position? And that comes from the statement of cash flows. Okay. Spreads is just a comparison of, how do you compare with respect to everybody else in the industry? Are you better? Are you more efficient? Are you less efficient? If I benchmark you against your competition, would I give you a A, a B, a C, a D, or an F? Right? Common sizing is, a lot of times I have historical data, and some components, some elements I go out and project and calculate on the basis of assumptions, inputs, and drivers. Some I calculate on the basis of historically, how much have we spent on this? Historically, what has been the balance in this specific account? So that's where common sizing comes from. And then the last and final step is, I've got a first pass. If I move things around, how much would that first pass change by, right? So that's the structure of a model. Inputs, what goes in, drivers, assumptions, growth outlook, and this is your your pre-processing, for lack of a better word. All of this is required to make sure that the model works. Then the next two big steps are income statement and balance sheet. The combined impact of income statement and balance sheet on my cash position is statement of cash flows. Spreads is benchmarking myself against the competition in the industry. Common sizing is to get a sense of a range of historical values. Just like we did the orders, average orders per month, average orders in Jan, average orders per year, average orders in quarter 1, average orders in quarter 4, average orders in quarter 2, 3. All of that was a common sizing effort. And then sensitivities, which is basically stress testing and seeing if I change any of these assumptions and models, what happens. So with Maya, what we're doing now is we're saying, listen, I'm going to work with orders and ticket size. And that's the essence of my model. So I'm going to use the sheet, and I sent this sheet yesterday to you. This is called Maya Model A1, and it looks like this. So it's Maya A1. It's an Excel file. It was sent to you yesterday, and if you come to, there's only one tab in it. It's very simple, very basic model. It says Maya Baseline A. If you just please open it up. If you've downloaded, that's great. If you just open it up so that you can follow it side by side, and when we do some of the stuff, you could do it with me, as we move forward with the class. Okay, all good. Shall we start? Bismillah. So the structure of our model, this is a static model. We're just starting off with a very simplistic basic model. The structure of the model is I've got a certain number of orders per month here, and I take these orders and multiply them by the order size. I have a sense of the contribution margin for each order, which is about 30%, and I have about 12 months in a year. And that gives me a sense of my margin. So if let's say my average ticket size, all of these numbers, by the way, are in AED. Let me just put this out, AED. So they're all in dirhams. Remember, Maya was doing two things. Remember, the first thing was they wanted to get a sense of what the outlook for 2020 was, what March was going to look like, and the second thing was their expansion, potential expansion in UAE. So the purpose, going back, what is the purpose of this exercise? The purpose of this exercise, from Maya's point of view, is fairly simple. They need to, actually they don't need to, they've been thinking about setting up a warehouse in UAE. And the reason, the rationale, the logic for setting up that warehouse in UAE is they want one place where orders can be shipped directly, where there are less issues with logistics, with supply chain management, and with other challenges, where there are even lesser issues with, tariffs, import, export barriers, trade barriers, etc. And they want to do it in such a fashion that they can use that warehouse to serve both the UAE market, the Dubai market specifically, as well as their Pakistani client base. So the market in Pakistan. And the game plan is, they already have very strong, very robust, very solid relationships with their vendors and suppliers in the Far East. They'll place the order, the supplier will ship the order to UAE. They have a small team, staff in UAE who's be running the operations. That staff will bring those orders in, tag them, catalog them, put them together, and keep them safe. And at the same time, they will just expand their operations from Pakistan to Pakistan and UAE. Their site will now start taking orders for UAE customers. They'll start quoting prices in dirhams, start shipping, fulfilling orders from UAE. Right? That's one part. And from their perspective, what it does is it gives them the option to expand not just in UAE, but also serve the rest of Middle East from UAE. So it's UAE, it's Oman, it's Qatar, it's Kuwait, it's Iraq, it's Saudi Arabia, and Bahrain. That's the expansion plan. But all of that is linked to the fact, can they justify the cost of the warehouse in terms of the expected operational cash, the expected business, the expected revenue they'll generate from the UAE market. So the model they put together is basically an attempt to get a sense of how big could their business in UAE get. Would it be profitable? Would it not be profitable? And then, if they buy the warehouse, would the warehouse be able to create enough efficiencies, create enough scale on their part for them to pay it back? That's the objective of the exercise. First part of the exercise, first step, is to figure out how to model revenues. And what Maya has gone out and done is they've put together a simple model for forecasting revenues. And that model has two components, two drivers. The first driver is order per month. The second driver is order size. Typically, traditionally, historically, when they worked with these customers, their margin is about 30-35%. Because they're starting afresh in UAE, and despite the fact that the UAE is a significantly higher margin country than Pakistan, their take is we are planning or going to be fairly competitive. So they've kept their margin within reasonable bounds. Typical margin for competitors in this space in the Middle Eastern market is in the 40-45% range. So they've kept it low, so make sure that their prices are more competitive. Same product, same commodity, same space, same vendors, same brands, but better, cheaper pricing online. So if you think in terms of margin per month, where does this contribution margin comes from? This comes from, if you just trace formula, trace precedent, it'll show you it's 30% of 250 dirhams. And their margin per month is simply all the contribution margin, this number, times all the orders they've processed. So that's their margin. Now fixed cost right now is static. We've just plugged in some values. We just have to see where these values are coming from. So if you look at fixed costs per month are coming from two values, general and administrative, which are static values. So this entire row, I've just put in a static plugged in value for now. As we go through the model, we'll sort of update this. We're going to use the same approach. Build a simple model, identify what's wrong, identify what needs to be improved, improve it, and then get back. And then their other expenses is also, so these are both fixed items. These are both static items for now. As we improve the quality of our model, these items will change. All right. So break-even orders per month, what does that mean? That basically means if this is their fixed cost, how many orders does Maya need to cover those fixed costs? So if their fixed cost is, let's say, 133,000 per month, then from the contribution figure that they have available on top, their take is that they need about 1,100 orders to break even. Okay, does that make sense? This is the heart of your engine. This is where you model the business drivers. Business drivers are, in this specific case, orders per month and order size and contribution margin. You plug that in here to get a sense of how much margin. And when I say margin, this is stuff that's available for you to offset everything else. So when you look at margin that's available, you comparing that margin with your fixed cost per month to get a sense of how many orders do I need to process to make sure that all my fixed costs, all my fixed expenses are covered. Okay, so that's two. This third piece, you remember the growth conversation we had? This is the same growth conversation but applied in a slightly different way with a twist. In the growth conversation, we were asking, Altamash, what's the probability that you will see a 35% decline? Or what's the probability that you will see a 45% growth? Or what's the probability that March orders in 2020 will be higher than March orders in 2019 or February orders in 2020, right? These are the questions we're asking. Now we're asking a different question. We're saying, I need about 1,000 orders per month to break even. I need 1,000 orders per month to cover all my fixed costs. Right now, I'm generating about 1,700 orders per month. What's the probability that orders will fall by 700? So if I look at 2020, this year, I have 1,700 orders per month right now. My break even is about 1,000 orders. The difference between these two is 700. What's the probability that I will see this shortfall in orders? That probability, the fact that this can happen, to calculate that, we need to convert this into a percentage drop. So if you think in terms of this order volume drop, 41, 44, 43, 43, right? So we're saying you're looking at, excuse me, percentage drop over the year, right? This 41, 44, 43, 43% reduction in order volume can be used to calculate the actual probability of shortfall. And this is surprising. In the Maya's numbers that we looked at earlier, we saw 35% reduction in orders. The number was about 13%. Our own estimate is about 18%. The number that we've used here is about 12%. Just look at the fact that shortfall analysis gives me a sense of what's the stuff, what would be classified as bad news. So for me, bad news is classified as the fact that my orders fall below a threshold where I can service my fixed costs. What is the volume that is required for that bad news to happen? A volume drop of about 40%. What's the probability of that happening? That number is 12.6. That number 12.636%. How we calculate that number, we'll come back to later. Right now, don't worry about the mechanics. Just focus on the concept. Just focus on the question. What is the question? The question is, what's the probability of me not meeting my fixed costs on a monthly basis based on my historical trend? The answer to that question is 12.636%. Right. So this is the engine, and then what you're doing is you're using this engine to go out and generate revenue. So P&L stands for profit and loss statement. You've got two possible terms. You got P&L, which is profit and loss. You can also call this the statement of net income. Now, the statement of net income is a very simple statement. It only has one simple objective. Right? The objective is, what are the dollars that are coming in under what heads, and what are the dollars that are going out, and what is left. That's the objective, right? So in Maya's case, we build a very simple statement of net income, or very simple projected P&L. In this projected P&L, where does gross revenue come from? Gross revenue would simply be the number of orders times your ticket size times the number of orders, number of months in a year. So if you trace this, you'll find this goes all the way back to here. It's basically 1700 into 250 into 12. So that's my first number, right? My second number is cost of goods sold. Now, what is cost of goods sold? Remember, you have this figure for contribution margin. So contribution margin is what's left over, which means cost of goods sold is exactly what it costed you to buy and purchase that. So if you trace this, you will find that that number, your cost of goods sold, is essentially this figure, which is your gross revenue figure, times 1 minus your contribution margin. So it's 1 minus this number. And if you press F2, function F2, you can see the formula. So the formula says 1 minus E11, E11 is this number here, into E29, E29 is your revenue. So that makes you your second number. And then your gross margin, the third piece in this equation, is simply the difference between the first two calculations. Okay. So this gets you, so you got your revenue, you got your cost of goods sold, and you got your gross margin.